Hi everyone, welcome back to my channel. My name is Roxanne Hayes and I am the broker owner of RHM Loans. And this is where we talk everything mortgage. So it's finally been released. And sad to say, by the time this video makes it out, the funds have already been secured. But that doesn't mean it's not coming back. So what am I talking about? I'm talking about Cal HFA Dream for All Shared Appreciation Loan. So again, at the time of making this video, the funds have been secured, but that does not mean that they will not bring the program back. So if they do, I want you to be ready and prepared. So if you're interested in purchasing a home this year or any time in the future, make sure that you talk to a mortgage broker. My motto is that mortgage starts with the conversation. And until you know what you don't know, you won't know what you don't know. So let's get into the program. This program is providing first-time homebuyers an opportunity to get 20% of the purchase price to be used towards down payment and/or closing costs. In this video, I'm going to explain how this program works and what are some of the specific guidelines. If you are in the state of California and are interested in applying, please check out my website, www.rhmloans.com, or shoot me an email at Roxanne, ROXANN, at rhmloans.com. Now back to the video. A first-time homebuyer is defined as someone who has not had ownership interest in a home within the last 3 years. So that means if you've never owned a home, you're a first-time homebuyer. And that also means that if you've already sold your home that you previously owned more than 3 years ago, then you are back to being a first-time homebuyer. All borrowers must occupy the property within 60 days after closing. That means any rent backs to the sellers must be completed before the 60 days. You cannot have non-occupying co-borrowers for this program. So that means anyone on the loan must occupy the property as their primary residence. Now, Cal HFA doesn't give specific loan limits for the programs, but we are going to be following Fannie Mae's guidelines. So different counties may vary. Here in Riverside and San Bernardino County, the loan limit is $726,200. Other counties like San Diego County, Orange County, LA County have higher loan limit options. To learn more about this, check out my previous video on conforming loan limits. Now, interest rates. Interest rates are set by the program, and these interest rates can be found on the link below. Interest rates are posted daily, Monday through Friday, excluding holidays, on the Cal HFA website. Mortgage insurance. So if you're a buyer who has the funds to pay for their closing costs and you take the whole 20% that's allocated by the program and put that towards your down payment, you will have zero mortgage insurance. But if you don't have the funds for closing costs, we can use 15% of the 20% that they provide to use towards a down payment and the additional 5% to use towards closing costs. So in a situation, because you're not putting 20% down, you will have mortgage insurance, but it will be much cheaper than it would be if you only put 3 to 5% down on a traditional conventional financing. So this does give you an option to purchase more home because you will now fall with a lower payment. Now, you may be thinking, Roxanne, why are you allocating 5% when the normal closing cost is 2 to 3% in the state of California? Now, this is true on regular loans, because on regular loans, the way your loan officer is paid is through the lender. When you do these types of programs, there are no lender paid options. It would have to be borrower paid, meaning it's coming out of your pocket. So what would have been paid by the lender in a traditional mortgage now has to be paid by you, the borrower. Keep in mind, if you do get seller credit, the seller can end up paying for these closing costs as well. For the shared appreciation second, there will be no monthly payment towards this loan. The 20% that is borrowed is at a 0% interest. That means no traditional interest is calculated for this loan. Instead, you will share percentage of the equity along with the original balance when there is a maturity event. The maturity event includes selling your home, refinancing to pay off the first, changing ownership. Here's a breakdown of how the program would work. Let's say you purchase a home at $500,000. 20% of that purchase price is $100,000. That's the amount that you'll be getting on the shared appreciation loan. So you will have a first mortgage at $400,000 and a second at $100,000. Keep in mind that second will accrue 0% interest. So no traditional interest is collected on the second loan. So if in 5 years you're ready to sell that home and now that home is valued at $640,000, that means you will have appreciated $140,000. You will now share 20% of that to CalHFA, which would be $28,000. But don't worry, you'll still get $112,000 of the appreciation. Now, you still have to pay back that original amount for the $100,000 borrowed and the $28,000 on the shared appreciation. So the breakdown on the $640 would look something like this. $370K to pay off your first mortgage. Keep in mind you've been making payments the past 6 years, which is why that principal balance has gone down. You'll get $128,000 in order to pay off the Dream for All program along with the shared appreciation. And that would leave you, the homeowner, with $142,000 to pay for closing costs and have remaining funds available for a future down payment on a new purchase. CalHFA prides themselves in home buyer education. So for this loan, you'll actually need to complete 2 home buyer education courses. All CalHFA programs do require a regular homeowner education course to kind of teach you the things that are included in a mortgage payment and what to expect as a homeowner and your responsibility as a homeowner. The second course that would be required for this program is going to explain the shared appreciation. Now, these homebuyer courses probably run you about $100. I'm not sure if it's going to be per course or if it's all included, but I would allocate maybe $200 towards closing cost for these homebuyer courses. CalHFA also prides themselves in helping low-income borrowers. So if you're not making more than 80% AMI through this program, you will have additional incentives. AMI is annual median income, and for Riverside County, that 80% amount is $69,900. So again, if you make less than $69,900, there are additional incentives for you. Number 1, you get a lower interest rate. Number 2, you're able to qualify at a lower FICO. So this program normally requires a 680 FICO, and for our low-income borrowers, they will allow a 660. Something to also keep in mind is that when you do have the lower FICO of 660 and 680, the max debt-to-income ratio is 45%. If you want to qualify for a higher home, they do recommend having a 700 FICO, and they will let you go to your 50% debt-to-income ratio. The last thing that the low-income borrower does earn through this is lower appreciation paid back. One of the big benefits of being a low-income borrower for this program is your payback on the shared appreciation is lower than everyone else. So if you are over that 80% AMI, you would have to pay back 20% of the shared appreciation. But if you are under the 80% AMI, your payback portion is only 15%. And if you want to find out what 80% of the AMI income limits are for your area, check out this link. Now for eligible properties. Now these include, of course, your single family residence. They can have a guest house or granny flat or in-law quarters. Those may be eligible. It still needs to be defined as a 1 unit within the zoning. Multiple units or accessory units are not permitted. And the good news is that 75% of the granny flat next gen income can be used towards qualifying. Manufactured homes, your standard manufactured homes are eligible. Again, must be built after June 1st, 1976 on a permanent foundation. Most cases you must own the land, so you can't do land. Condos and PUDs are also eligible, but they do still need to meet Fannie Mae guidelines. So you can't have high investor concentration within those condos. All properties must meet health and safety code. So that's it. Thank you so much for watching this video. If you haven't already, please like and subscribe and hit that notifications button for the next video. Make sure you follow me on other platforms. I'm on Instagram, Mrs._mortgage_rocks, and also at TikTok, Mrs. Mortgage Rocks. And remember guys, mortgage starts with a conversation.